Tom, looking at the bank sector this morning, it's, well, similar to the carnage that we've seen throughout the rest of the market, even worse perhaps again today. We know interest rates being low for an extended period of time may not be the best for banks, but is there also just a concern overall in terms of the credit quality of their assets, given the declining financial fortunes of so many corporations in the United States?
David, there is a lot of concern. We're getting reports back, really, I think, of unprecedented slowdown and shutdown of businesses. So I think it is of a concern. Our approach to how we think about this is that we don't think we have enough information to figure out exactly what's going to happen. So what we've been doing is we've been stress testing it, and we've been looking at scenarios. And our opinion is that what happens over the next couple of months is going to be very manageable for the banking industry. We think what we're looking at right now is really somewhat of an earnings crisis, not a balance sheet crisis for the banking industry. We've already seen how banks have shut off their buybacks. We think their dividends are still going to be paid. This may cost them a good portion of their year's earnings, but we think, broadly speaking, for the banking industry, that they've got the capital and the balance sheet to be able to handle what's going to be coming at us over the next couple of months.
Well, if that is the case, then one would expect that you would think you need to be brave and buy the stocks. Is that the case? When I look at a Wells Fargo down 47% or a Citi down 54%, these are year-to-date numbers, by the way, or a JP Morgan down 37%. Is it time, in your opinion, given that what you just shared, to actually buy some of these stocks?
I do believe that. And by the way, what I've been telling clients and colleagues is cheap stocks can get cheaper. And the technicals aren't good for the banks. If you even look at Monday, it was the biggest ETF flow day of the year into broad-based ETFs with over $9 billion. But financials had an outflow. So the technicals are terrible, and that could continue. But my opinion is that if you're an investor and look out beyond this, and we keep comparing this to the global financial crisis, we think that buying the trophies that are on sale or the better companies at these prices, if you can withstand the volatility, that our view is that the banking industry is in good shape. And we're going to be figuring out in the coming week what our earnings estimates are going to change to. But we think that most of the dividends, almost all the dividends, will probably be good. And we think that the balance sheets will remain intact. So the answer to your question is yes, we would. But also, there are companies that may have more than average exposure to certain areas of energy or others. Those will probably not do as well as those that are a little bit more national or broad in scope. But we do think that some of these stocks are highly attractive.
Tom, there is a broad expectation that the Treasury and the government is going to come up with some sort of way to aid so many companies and encourage them to keep their workers. But if that doesn't happen, and if we get to this idea of, let's call it a 15% or 20% unemployment rate, as apparently the Treasury Secretary at least expressed to some GOP senators, have you stress tests for that? I mean, can the banks withstand that kind of unemployment rate?
Well, look, my opinion is that I don't think you're going to see a banking crisis like you did, again, back in the 08 to 2010. We haven't stress tested 20% unemployment, but the banks are in a very good position, and I think this may be a situation where we're seeing unprecedented government, well, not unprecedented, we'd had a lot of government support in the prior crisis, but that crisis almost started with a banking crisis. That's not the case right here. And we think if these government support programs keep rolling out like they're being talked about, I think that's going to come to the aid of the economy, which will help the banks.
Tom, I'm wondering what you make of this sort of collective action among some of the very large financial institutions. One, to agree to cease buying back stock, and then two, to make that gesture of going to the discount window at the Fed and making use of that. Now we have these other facilities. The Fed is announcing allowing primary dealers in government bonds to pledge almost any type of securities and get very inexpensive loans from the Fed off of that. Do you see banks utilizing that to the fullest, or there's still going to be some reluctance for them to free up their balance sheets in those ways?
I think banks are going to use it, and I think some of the best performing banks in the nation are going to use it quickly and probably tell other people about it to make sure it's destigmatized. And look about what I think we need to do. I think most people believe that this is temporary in nature if it's held appropriately. We need to get this virus behind us and think about where interest rates are. Interest rates are zero or near zero. If we can, so the interest expense is not great. We need to have the banks and we need to have the regulatory flexibility to give the banks the opportunity to delay principal payments so we can get beyond this period. It could be manageable if all the forces come together between government, and I like the fact that you talked about a collective nature, because in my conversations with CEOs, that's how they're thinking. They would like to do that.